Hi guys, it's Chad Larson with MLD Wealth Management Group with Canaccord Genuity. I'm joined here today by Mark Eibel, Director of Investments with Russell Investments. Russell's been a phenomenal partner for MLD for many years. They're an incredibly large asset manager based out of Seattle, Washington. And Mark's joining me today for like everything and everyone seems lately from the comfort of his living room. But Mark is a featured speaker, writer, analyst, and all-around market guru guy that I've really enjoyed talking to. And I think one of the things Mark and I were talking about last week before I dive into it is what I really enjoy is so much of what we do in this industry is jargon, and anecdotally, I've tried to turn a lot of this into parables or stories or things that we can understand with crayons. And if you can't explain something with a crayon, it generally means you don't understand it well enough yourself. But we're going to talk the general economy, general market update. It's not about the numbers, initial jobless claims, and all of that is, I think, meant to pander to people's sense that we're really smart. But we just need to make sense of this. So, Mark, it's a pleasure to have you here today. And I'd love your thoughts to go on a tear and tell us what you're seeing down in the U.S. and what Russell's views and your views are of the general economy and what this all means. We live in interesting times.
Sure. Thanks for the opportunity. And I agree with you. Everybody that's watching or listening to this, no matter what your profession is, you can make it as complicated or simple, I think, as you want to. And I think we are certainly guilty in this industry in particular, with so much terminology, so many acronyms to really, you could make it confusing if you want to. So I will hopefully not do that today, but I guess you'll all be the judge of that. Let's kind of start. I mean, I think you have to start with just looking at what's happened so far this year. We're in May. It feels like 2020 has been going on for years. A market high of February 19th, which seems a lifetime ago. And I still think on a fairly regular basis, we have elections about every 4 years in the States, and we have one of those coming up in November. What an unbelievable year, start to finish, this one's going to be. But I think any conversation has to let's just kind of put what's happened so far in context. I often get the question, this downturn feels different than others. Is it really? And the answer is no and yes. So I'm sure that really clears it up. So let's dig into that a little bit. In the sense of the downturn and how far we turned down, the answer is really no. If you look at the 12 or 13 markets, really starting with the Depression and going forward, where we've dropped 20% or more, commonly kind of called bear market. 20% is that threshold that usually puts you into the category of not good and not good experience. Over half the time, you drop between 20 and 40%. And in the States, and it's pretty similar everywhere, because all markets, when you have something this global in nature, all tend to go down about the same amount. This one certainly didn't spare anybody. Down about 35% at its worst. If you look at the highs around mid-February to the low of March 23rd, a 35% drop. When the whole quarter was said and done, and it's interesting, even when you take into account the currency difference, I think the U.S. and Canada both dropped exactly the same in first quarter, start to finish, around 20.9%. The U.S. in U.S. dollars, and obviously Canada and Canadian dollars. It's weird. It's almost the same number. So, but at its worst, we were down 35%, down 20 to 40 over half the observations, and there's about 12 or 13 of them since the Depression. That's how far you drop. Now you get a handful where you drop more. You don't have to go too far back in history to experience two of those. When the tech stocks crashed around 2000, and obviously the 2008 recession, we dropped 45 to 50%. So this is the third one of pretty good size within the last 20 years. And we'll kind of talk a little bit about, when we talk a little bit about what do you really do as an investor. I think that experience for many folks who will be listening or watching this, kind of can be able to draw on your own experience. I'd rather not have too many more of these for our experience to get better, but this is the third one of size. So in that regard, this drop is right within history. The outlier, by the way, is the Great Depression, a comparable you never want to be compared to, where we dropped 83% top to bottom. Now, we also had central banks and governments doing the exact opposite of what we're doing now, which probably prolonged it. And that kind of usually triggers, and you're starting to see the word depression show up a lot, which is a scary word. I understand that. Let's quickly just define it. There is no definition. That's how fast it is. There's no definition of a depression other than it's a really, really, really bad recession, to put it in technical terms. A recession.
Jumping in for a quick second on that.
Yeah.
In high school, I had a economics professor. I lived overseas, and his name was Mike Austin. A big shout out to Mike Austin. He was also my economics teacher in grade 10. And it made me go down the path of pursuing economics as an academia. And when we looked at the Byzantines and the Romans and all of these things, and even fast track, we talk about the Depression, we talk about the flash crash is 87, the 09 great financial crisis. When you're in something, it doesn't have a name. And so I think when you're talking about outlining what is a depression, I don't think people woke up for work, or I guess probably lack of work during that time, and said, wow, another day of depression. So we jump really forward, and I think it was you and I talked, what is different this time? We're all at home.
Yeah.
It's weird.
I think that's it. I mean, from a how much the market's moved down, it's right within history. But this one, that's why I said the yes and no. But so from a number standpoint, has this correction been different? No. But it feels different, right? It's personal. It's health driven. So we've got that on our minds. And even in other downturns, you could go out to eat. You could still go see your family. You could go to a sporting event. You could go to a concert. You could go to a worship service. I mean, no matter how bad things got, you still felt as if you had some control over your life, and we're all quarantined. So in that regard, I think it is this personal nature that makes this one feel different. I think the second reason is the speed of the downturn. Even when you include the Depression and 1987, where we lost over 20% of the market in one day in the States, both of those still took longer to drop over 30% than this one. This one, February 19th to March 23rd, you wipe out weekends, and you're not looking at very many trading days. And I think the speed of it makes it feel different. And I think the reasons are ones that everybody talks about. The amount of trading you can do instantaneously now. It would have taken weeks or months for traders to do by hand. Markets are cheaper to access. You can access them all day long. So maybe this is what downturns look like moving forward, which I don't think is all that bad for most of us as investors, because usually the mistakes that we make in investing is in the down markets, and it's getting out. If markets move this fast, both directions, you have less time to kind of, and the natural reaction is to sell. It's rip the Band-Aid off rather than the slow pulling of a Band-Aid over months where the grind gets at you and you just throw in the towel. This way, I mean, if the market drops 2,000 points in the Dow in a day, do you really want to put a sell ticket in that night? I mean, and then if you get a huge move on the upside, you feel good and you don't want to do it. So I think the speed is legitimate of why this correction is faster than others. Behaviorally, I think it might actually save a lot of us from making mistakes. And I think you also have to remember, if you want to blame the machines on the down days, well, when the market goes straight up 5% in a day, the machines are helping you make money too. But they're all just programmed by people. And when we circle back to how we started this conversation, the market still got to the same range of a down 35% or so, top to bottom, that it did in all those other periods in the past when we didn't have all of this. But I do think, to your point, it's the personal nature and the speed that make this one feel
different. You talk about like the ability to come in and out and access the market, and that slow grind, and the ability of technology and market access to make things faster. One thing to quantify too, and it's something that I have a Bloomberg terminal sitting next to me, and it's some of the neat gadgets on it. I'm not going to run models, and I'll leave that to our armies of analysts that are much smarter than me to do that. But the augmentation of the platform of traditional media has changed so much. There's Twitter scores now on companies, and and AI and hedge funds are driven quantitatively off sniffing Twitter, and everyone seems to have the next Pulitzer Prize based on their writing with 146 characters or whatever it is on Twitter. News and fear. News is a tough one. I'm talking to an American today, so I'm not going to get into that. News used to be something that provided you data, and that allowed you as the reader, viewer, listener to make your own risk reward analysis. And now, unfactually, it seems that he who shouts the loudest or gets the most clicks becomes these authoritarian things, and that does swing markets faster. But again, I'm glad they happen fast, because it gives people less time to make poor decisions, and hopefully people like ourselves to make phenomenal decisions that can react to opportunities in them.
Yeah, there's certainly not a lack of data, but it's still, I mean, there's a difference between perspective and information and data, to your point. And I mean, people say, well, the world seems to be more negative news than there was, when I was growing up, so to speak, or there's more news. And I just think we know about stuff faster, right? I mean, anything negative that happens, we instantly know about it. We're not reading about it a week later in the news. So I don't know if the world is really that much different, other than, as you say, we just hear about it so quickly. And by the time it hits Twitter, it's already built into the price, right? I mean, that's a kind of a common line now. And I do laugh at I participate in the business media, but I don't think most of us are probably helping the average person at home. I mean, every other day is a markets in turmoil special, right? I mean, they never call them, hey, markets are up, let's be happy specials. I mean, nobody would probably watch them, but it is constant. In the long run, the valuation of a stock and what are its earnings like, and what's the backdrop of your central bank still is what moves prices. Political policies obviously in the longer run do that as well, but you really kind of have to fight through the day-to-day barrage. And we know, whether it's business media, political media, any kind of media or news, the bias is going to be to the negative, because for some reason, as human beings, we watch more often, right? If it's a natural disaster and they say new footage after the break, we stick around for the footage, right? We're just kind of wired for sticking around if it's more negative news, and the media knows it, whether it's business or unrelated. So you kind of have to battle through that and have a plan and work with an advisor like you. And I mean, all that is what really helps you through. But boy, the more, we certainly don't lack data, but I think we lack information.
We definitely don't lack news. Let's segue into that a little bit. What does all of this mean in the simplest terms, from having shut down, what's the total size, is $27 trillion economy in the US alone? What does that mean to an economic background in simple terms, so that our clients can better understand what does this, we saw Q1, we accepted that it was weak. Obviously that's January, February, and March. And March was really the only first month that things started to really kind of shut down. Like I was in LA in March, and it was starting to get weird in the airports. It was all on CNN, you name it. And, 2 weeks later, it's like, I can't ever remember last time I was on an airplane, which is rare for me. Now we've got April, May, June. My God, nothing, complete economic real shutdown, other than skip the dishes and Amazon, I guess. What does that mean? We're seeing, and I don't want to talk the numbers of it, but with all these people not working, and even we are seeing states reopen, we are seeing provinces open, we're seeing countries reopen, and that's under these. And I hate the word new normal. I don't believe it's normal to be restrictive like this, but it's a reality that we live in. So, what does this mean? Because I think anyone in my position has gone through a phase where they end up somehow being financially involved in a restaurant or a bar out of ego, or friendships, and they don't necessarily all work. But I can guarantee you, no restaurant is going to make money having 50% occupancy, and airline carriers cannot make money. What does this look like into an economy? I saw Qantas Airlines put something out, and they said, under these new new recommendations, an average $200 flight would cost $3,000 to $4,000 if the passenger loads are slower, the gate slots are getting wider. How does what does the economy look like? And albeit the Fed has their bazooka, do you run the risk of the devaluation of currencies that do maintain a prolonged economic slowdown? Or is this like the great financial crisis where you have a complete debasement, and that's my fancy word of saying, everyone just has less money together, but we're all kind of the same? Is there opportunities for countries to take leadership here and start to shift that and see that in currency as well?
Yeah, there's a lot packaged in that. I think that was about a 14 in the old SAT days or what. I think that was a 14-point question for a final exam.
One.
So, but I mean, and we're in the period of your exact issues that you're talking about. I mean, you have the market for whatever reason. It's always different. This one happens to be healthcare driven. The market goes straight down. Then you get this big bounce back, which really started the last week of March. And then April was one of the best months in, again, 80 years, and May's been pretty good. And now we enter this period of, so where do we go from here, to your point? And it's not, you're right, it's not an earnings number, it's not a jobs number, it's not an economic number. By the time those get better, I mean, the market will already have moved. It's what makes investing so difficult, because the market went straight down before the economic numbers ever got bad, but we all knew they were going to be bad, right? And now the market's having this big rally, and we're getting jobless claims. I think we're up to 36 million in 8 weeks in the States, and the market's been flatter up on every single day those numbers come out.
That's like all of Canada.
So I know it's just mind-boggling, right? So you've got this period where it isn't going to be the numbers that drive it, so to speak. So we're entering this period where I think really there are three things. None of them are really an economic number that's going to determine where do we go from here. Number one, it all starts and ends medically, right? I mean, we need some sort of a solution, whether it's an existing drug or a vaccine, probably a vaccine eventually, in order to really kind of say, okay, coast is clear on this one, as far as getting some semblance of a normal life back. So, and the market moves on every rumor of testing. We see that daily basis. The second one is exactly the point you're bringing about, this experiment about either opening up state by state or country by country. We've never done this before. We've never shut down a global economy and then tried to figure out rules for opening it up again, and everyone's in different fits and starts. We're kind of in the honeymoon period, I think, on that right now, which is why the market is responding more positively than negatively, because you get the optimism of states are opening up and we're getting some form of our lives back, without knowing if the cases are really spiking yet because of the delay, right? And I'm assuming as we do more testing, that the cases are going to go up no matter what. So we're in this period of, are we gonna, okay, it's going to be okay, and we're going to slowly figure out the rules moving forward, or are we going to shut down again? And when people say, could we test the market bottoms again? That's the scenario to test the market bottom, right? I'm assuming that some brilliant researcher somewhere in the world, when everyone's working on the same problem, is going to come up with a medical solution. So I'm going to be an optimist on that. But if we shut down the states again, that's going to be a tough one for people to kind of feel as if they're back to ground zero again and starting over. So I think that's the second thing to look for. And I think the third one, to your point about the bazooka.
Is that the white swan risk?
So yeah, something like that. So, and then there's the bazooka approach, right? And in the States, it's $2 trillion fiscally, on top of maybe 5 or 6 trillion that the central bank's putting in, and everyone's taking their rates to zero. You guys did the same thing. Everyone's putting money in the system. But just using the U.S. as an example, I can't even imagine the administrative challenge of getting $2 trillion into the hands of individuals and businesses on any sort of timely basis. I'm not saying you can't do it. I'm just saying that's a tremendous challenge, and the success or lack thereof, I think, moves this market more than anything else. So instead of earnings and jobs and economic numbers, we're looking for, vaccines, the experiment of reopening up states and economies, and administratively getting money in people's hands. Those are the indicators right now on the direction that this market will move to. And that's just stage one to ultimately get to the second part of your question, which is, so how long will it take us as individuals to say, I'm willing to fly? Cruise bookings seem to be way up. So I guess at a price, people are going, I'll take my chances, which really surprises me. But to your point about restaurants, you're right. I mean, it's going to be different rules moving forward. And while the businesses themselves might be able to get by, it's hard for me to see how does the employment all come back if you're only, I mean, using the example of restaurants is a perfect one, if only half the seats are full and it's a lot of it is takeout. So lots of things to process as we move forward from here. But the first stage is getting through at least those first three things. The flip side is if you got a vaccine, the market would rally so hard off the bottom, and maybe it'll be like almost like post 9/11, where how long does it take people to start forgetting? Maybe this will be another one where once the vaccine's out, we'll get back to our lives faster. But it's hard, to your point, in this middle of this, it's hard to see that. It's hard to see that at this point.
And it's like the age old, we all use quibs and colloquialisms and parables, as an economist or as a financial advisor, like hope isn't a strategy.
Right.
And so we're trying to navigate, and the phones are, they ring and people are looking for guidance. And aside from trying to be a financial shaman, we want to put our academia and our knowledge and our data to work. This is going to be a challenging time. There's as many reasons to be bullish, call it at a sentiment level, and monetary and fiscally, and then that fear of how to manage something that we don't know. That being said, can you comment a little bit about, and I don't have the number in front of me, and I said I wasn't going to talk numbers, but I believe the credit markets, the bond market now has raised over $1 trillion year to date on corporate issuances. Like, funds are flowing. That's obviously taking in fact advantage of the fact that interest rates are at near zero, and the Fed has said they'll backstop and buy everything, including junk. So if you're ever going to raise credit, do it now. How do we solve for that in the long term? And maybe we don't even have the time now, or does it matter? Because the short term, it's kind of like having an inverted yield curve on expectations. The short term is going to matter more than the long term, because unfortunately, when we have these massive spikes or sell-offs, some people do get bucked off the proverbial investment horse or the roller coaster. And it's sad to see the people that aren't working with an advisor and aren't anchored in process and people and philosophy, and have people like you guys shepherding them through this. Those are those sad scenarios where you see that. But long term, the balance sheets of all G7, all developed countries in the world have to be stretched.
Go ahead.
Yeah, what do you do after that?
Yeah, I mean, you're really
that since 0809.
It is interesting. You think, I know, and it's funny because coming out of this crisis, we're going to be all the same questions are going to be talked about that we asked post 0809, which is, well, what does this mean for inflation? What does this mean for deficits? And what does this mean
the world's
for debt?
largest rug?
It's a rewind button, right? So, I mean, you're right. In the short run, there's tremendous opportunities. And it's funny because everybody always talks about the sell-off on the equity side on things like this. But as far as like active pickers of, active stock pickers, but in this case, active security selectors on the fixed income side, there are opportunities in the short run, because you're right. What happens in a crisis is everybody runs to the most defensive government security, right? So the US 10-year got down to 0.3%. I mean, I don't care how low your inflation expectation is for 10 years, you're going to lose money, and people were buying it all day long, right? Well, in order to buy it, they had to sell everything else, which is corporates, high yield, et cetera. And those interest rates move out. So here you go. You've got, you've got the Fed comes in and says, just like they did in 08, where they said, well, we're going to buy mortgages and treasuries. And this time they said, well, we're not only going to do that, but we're going to buy corporates, we're going to buy everything. And they didn't really put a dollar figure on it this time. So it's almost like, Mario Draghi, who's just this head central banker, was before Lagarde in Europe, when he had his whatever it takes moment. Powell basically stole his line of whatever it takes. So when the biggest buyer in the room is coming in and buying those securities, I want to be on the same side of trade as them. I don't want to trade against the central bank, because when you buy them, the prices move up and the yields move down, and you get a nice total return there. So in the short run, there's tremendous opportunities, I think, in the bond market. But in the long run, I mean, isn't there a consequence to pay for? I mean, the Fed put 4 trillion plus on their balance sheet in '08, and now they're putting maybe another 5 or 6. The Fed could have an $11 trillion balance sheet when this is all said and done. And before '08, it was less than a trillion. Now, no one knows if that was the right number then, but I mean, you're increasing it 10 or 11 fold. And from an inflation standpoint, I mean, you're not really seeing any consequence yet. So that's the scary part down the road. Now, the good part is, if there's a good part, is again, these interest rates are so low, which again, if you're a corporation, I remember several years ago when Apple was issuing debt and everyone said, I mean, when you compare Apple's balance sheets to God's, God might have a more cash on hand, but I don't know, maybe Apple does, right? And yet they were issuing debt. Why? Because if you're going to give them such favorable terms, well, why not issue debt and, use it for other purposes? So interest rates are so low. It's like the old adjustable rate mortgage, right? You can buy a bigger home with a really low interest rate, but eventually, if those rates reset, that's a problem. So in the short run, there are opportunities. In the long run, it's kind of like toothpaste in the toothpaste jar. It's not I can contain it, but once it's out, I can't put it back in. And that's how it feels on debt levels. And you can look at some emerging market countries around the world in history and go, this generally doesn't end well. I'm not saying the U.S. is in the same situation. We're the world's reserve currency. We're the biggest, most diversified economy. We've got some runway on this versus others. But at some point, you would think it kind of matters on these levels. Now, again, in the heart of a crisis like this, what central bank or government's going to say, I can't issue more debt? It's all about bringing the virus rate down and preventing fatality. So, of course, the answer is do whatever you can to get through the crisis. But when times are good, we don't seem to ever bring the number down, do we? Both sides of the aisle spend a lot of money. They just spend it on different stuff. So it's not a short-term issue. The problem is trying to identify, well, when is it an issue? And by the time it is, then it gets very difficult to solve.
Any fears on that? Like, any fears on, it's the only reason someone can borrow debt is they believe the lender believes that you can pay them back. And arguably, it's never even been a question. The U.S. is the largest, strongest economy in the world. But if we're seeing some other non-systematic market interventions and some discussions out of, I'm not going to go right or left or call out certain parties. It's a tough enough time in Canada avoiding the topics. I'm not going to engage one in the US, nor am I qualified. But if you look at some of those market intervention topics that have been floated, are they short-term imposing companies not to buy back their shares, not to increase their dividends, so you can start to, you're asking companies and people, we use fiscal and monetary policy to constrain the consumer and raise interest rates to maybe slow down the housing market. And now we're already seeing some conversations in and around, hey, we're going to give you a lot of free money, but no increasing your dividends, no buying back your shares. So we're going to slap them on the wrist a little bit, so to speak. But we're doing that at the government level. It's a tricky one. I just got.
It always is you're getting at it's the intersection of politics and economics, right? It always. I mean, there's the optics involved, and so many of those things you mentioned on the surface, you go, well, that makes sense. There should be some restrictions here or there, but again, it's a slippery slope, and then it starts leading to other things. It's kind of like shutting down an entire economy, right? There's ramifications that you might not think about, and again, you're trying to deal with the virus, but there are consequences that happen that you don't think about because you can't process it all. So again, it's the ongoing intersection between economics and politics, and we're certainly seeing it play out on a very big stage, not only here, but everywhere around the world at the same time.
Yeah. Mark, we got a couple minutes left. Like if you had to tell a story in 2 to 3 minutes about where do we go from here, we really framed it over the last minutes. We have optimism, we have pessimism. We're going to be bumping around. I'm not looking for a market call. I think should we talk about doomsayers all the time? An optimist has to be right all the time, and a pessimist a doomsayer only has to be right once. So, we're innately, as much as in our financial profession, we're pointed to when we get the call wrong. It's pretty easy just to be negative all the time and eventually be right and say, I told you so. Well, what's the modi operandus for the next quarter?
Yeah, I don't know about the next quarter, but as far as longer term, I mean, I tend to be more of an optimist, but I use it with data and I use market history. I mean, if you look at these downturns that we started out the conversation with, these 13 downturns, I mean, that includes the Depression, World War I, World War II. I mean, I wasn't around during those, but I mean, the economies weren't functioning at all. Entire societies were basically starting over from scratch again after world wars. I can't imagine as an investor going, it's okay though, we'll get out of it. And yet we did. So markets adjust. I mean, markets go up 72% of the time, good times, bad times over long periods of time. Those are pretty good odds. And you can't see it in the middle of a crisis. This is certainly a unique one in its cause. But, you know, '08 was about leverage. '99 was about valuations. They all have their different things that trigger them. But I think if you look back at time, again, if you distance yourself, if you would ask market participants throughout all of those, they would have said, maybe with the exception of the Great Depression, the markets came back faster than I thought. They adjusted faster, and the world moved on. You know, technology changes stuff so fast. It's so hard to say, well, we'll never get out of this problem. So I think it all comes down to having a plan. I mean, the issue is with longevity. People used to be, oh, I made it till 65. Whew. Relief, I made it. I did all the hard work saving up to it. I buy a lot of bonds and I live off the interest and any sort of social programs that your country offers for the rest of your life. And now people are going to be in retirement maybe almost as long as they're in their accumulating years. To me, the investment challenge almost starts when you retire. So you're going to have to be invested in something moving forward. And if you have this view that it's different this time, again, I'll say, you know, I'll be wrong one time, and that one time that I'm wrong, no one's going to care what you and I talked about today, right? So you have to be invested. You have to assume the world will adjust. In the end, people will do the right thing when pushed to it, maybe with politicians eventually, and just look at those other periods in history and go, wow, if they got through that, we'll get through this. And it all comes back to having a plan and a direction. If you're just aimlessly letting the market dictate your behavior, again, we all study buy low, sell high, but in reality, we tend to do the opposite unless we have a process and we're working with somebody. So stick with the process, assume the world will live to fight another day. The sun will come out the next day. Might be a little rainy at times, but the sun will come out and we'll adjust and solve this stuff as we move forward.
Awesome. Mark, that was the summary warms me. That was fantastic. I really appreciate your time. I look forward to doing this again with you soon, hopefully in person, and we'll go from there. Thank you again.
That was great. Thanks. I enjoyed the conversation very much. Be well, Chad.
See you.